Now we'll be talking about the different ways you can analyze the market. When I'm talking about the market, I'm speaking specifically as it pertains to the forex market. There are two different ways in which you can analyze the market. You have the fundamental analysis and you have the technical analysis. Now, what I've seen over the years is a lot of people tend to try to argue which one is better, whether technical analysis is better or fundamental analysis is better. Uh, what I'm trying to do here, what we're going to look at, what I'm going to talk about in this aspect of the course is not whether which one is better. Yeah, maybe at the end, I'm going to tell you which one is better, in my opinion. But then it will be left for you to understand the factors that make up these two types of analysis, and then you can make the decision by yourself at the end of the course how you want to go about analyzing the market. I'm going to be able to show you some of the ways that I do it. I'm going to tell you my opinion and why I think my opinion is right, and then you can decide and make the final decision by yourself. So, what is fundamental analysis? So, fundamental analysis is when you look at the micro and macroeconomic factors that actually drive the market. When you look at geopolitical events, when you look at news, so you get to see a lot of people that just think fundamental analysis is just news. It's not just news. There are data that actually drive this market, and though all of those data can be put together and put under the name fundamental analysis. Now, when you consider technical analysis, you are looking at price, the volume, volatility, and not just volatility, but chart patterns on the screen. Those are the things that make up technical analysis. Now, I've just given you the two definitions of the two ways you can analyze the market. I've told you about fundamental analysis. I've told you about technical analysis. Now, let's focus on fundamental analysis. In fundamental analysis, you have two major categories of fundamental analysis. So you have the exogenous factors, and then you have the endogenous factors. Now, forget about the big word. It's not that difficult to understand. So, endogenous talks about what happens within the country, and then exogenous talks about what happens outside of the country. So, because you know you are dealing with currencies, so what happens outside of the country actually plays a part in the price of the currency that you are trading. Now, imagine the fact, or rather consider the fact that when you want to trade a currency, you can't just buy one currency. You can't just buy GBP. You have to buy GBP to sell another currency. So you have to buy GBP, for example, in order to give up, let's say, US dollars. So GBP USD. So it does mean that when you want to analyze GBP, you have to consider what are the external factors, externalities that are actually contributing to the price of GBP. What is happening in the US that would possibly contribute to the price? Those are exogenous factors. And then you have the endogenous factors. Those are the things that happen in the country, within the UK, that are actually driving the price of GBP. Yeah. So the endogenous factors, something like interest rates, something like servers, something like building permits, something like employment statistic reports. Those are the things that are endogenous, because the employment statistics reports that you get in the UK is not the same that you will get in the US. It's not the same that you will get, in the EU. Because when I'm saying EU, because we have euro as a currency in the EU. And then when you look at the exogenous factors like relative GDP, so what is the GDP factor, gross domestic production of the UK, in comparison with the GDP of the US? How does that play a part? Then you look at interest rate differentials as an exogenous factor. So these are the things that you'll be looking at when we categorize the fundamental analysis, and you categorize them into two: exogenous and endogenous. So let me repeat again so that you'll be able to remember. So you have the endogenous factors and you have the exogenous factors. The exogenous factors are the externalities, things that happen outside of the country that contribute to the price of the currency. And then the endogenous factors are the things that happen within the country that contribute to the price of the currency. And then under the endogenous factors, you have something like interest rate, because the Bank of England, because I use GBP as an example, so you have the Bank of England that make interest rate decisions for the UK, whereas you have the Feds that make interest rate decisions for the US. So interest rate is an endogenous factor because it occurs inside. You have building permits, you have employment statistics reports under endogenous factors. Then under exogenous factors, you have something like interest rate differentials and you have relative GDP and the rest. So I'm going to give you like a table of these things, like where you can see endogenous, exogenous, and then you can see the differences, and then I'll give you the full understanding of all of these factors and where you can actually get the data for them. And then these things will help you to be able to make more informed decisions when you are doing your trading. Now let's talk about exogenous factors. These are factors, external factors that affect the economy. Remember when we talked about the endogenous factors, those are the internal factors. Now exogenous is you are dealing with externalities, things that are not entirely within the control of the economy. So affecting the economy can also lead to the effect on the country's currency, or even the entire stock market of the country. Now we have four major categories of exogenous factors that actually affect the economy. We have the balance of payments, BOP. We have relative GDP, we have interest rate differentials, and then we have commodity price. Now, let me talk about commodity price for a little bit. Now, commodity price, some people would argue that it's not an exogenous factor. And actually, most of the text that you might read, if you want to be a trader or even as an economist, if you are one, wouldn't tell you that commodity price affects is an exogenous factor that affects the economy. However, I've put it there because of my own experience. Because if you really look at it, think about the EU. EU is not they're not known for crude oil. They're not known for. I'm using crude oil as an example. They're not known as the crude oil crude producing sector of the world. It's not known. If you look at the Eurozone, for example. Now, however, the price of crude plays a part or affects Eurozone in so many ways, in so many different forms, because obviously we all know that crude is still very much important to the world economy, even though things are changing now. We are all going electric and a lot of other renewable sources of energy are being explored, but crude is still prevalent. It's still one of the major commodities that actually affect every given economy. I've just used this as an example. We can even look at the same thing for gold or even silver and every other commodity. So that's why I've added it as one of the categories of the exogenous factors that affect the economy. So we have balance of payments, we have relative GDP, we have interest rate differentials, and then we have commodity price. So let me write these things down. So I've written relative GDP already. Interest rate differentials. BOP, that's balance of payments. And then commodity price. You can say price of commodity. You can say commodity price. Now I'm just gonna take a little bit of time to go into these. I'll pay most of my attention on here because I feel like I need to explain that, and also here, or maybe a little bit of here. I've already talked about commodity price, so there is nothing there that that warrants further explanation. You can always read the PDF that is attached to this. I will put in more. I'll add in more information that is relative to the particular category that you want to learn more about. Now let's talk about relative GDP. I'm going to wipe the board. Let's talk about relative GDP. Remember, that's part of the exogenous factors. And like I said, I'm going to dwell a little bit on the categories that we have without wasting much of your time, because obviously you can and you should read the PDF. Yeah, there's always more, you always have more information in the PDF. But then it's always good to also give some brief explanation. So relative GDP, what does that even mean? Now remember, with trading, you're always comparing, especially with currencies, you're always comparing one country or one currency against another. Bear in mind that everything that we've done here with endogenous, exogenous, we can still apply that to the stock market to some extent. Not even to some extent, to a large extent, because we are talking about the macro and microeconomic factors that affect the economy. So you can still apply that in a large extent to the economy. But then for the relative GDP, we are looking at comparison. So how does the GDP of the US compare to that of the UK over a specific period of time? Now, the question would be for someone that does not even know, what is GDP? So that's gross domestic production, gross domestic production. Obviously, you can say gross domestic product and just stop it here and say gross domestic product. Now, what is gross domestic product or production? We are looking at the entire production level with services and goods and services produced within a country over a particular period of time, or within a geographic area, because it could be the EU, which is not really a country, is a whole zone within the Eurozone over a specific period of time. But then to do this, for the sake of actually learning how to use the information, you really need to look at it as relative GDP. And then to get relative GDP, we need to look at it as GDP per capita. Now, the reason why you have to look at it at GDP per capita is that the GDP value for a particular period of time, let's say a quarter, first quarter 2020 in the UK, could be something like 600 billion pounds sterling. But then, how do you understand how do you get a clear picture of what the final consumer, the end user, how they feel about the economy? You won't get that clear picture by just looking at the GDP data. You can't make use of that information. You can't just look at the GDP data and then place a trade. You know, you can't just say, oh, GDP data just came out, UK is 500 billion and the US is 400 billion. Because of that, I'm going to buy GBP and sell USD. You can't just do that. Now, for you to even be able to compare that, what you need to look at is the GDP per capita. So which is, for one person, for the final consumer in that country, how does that GDP relate to them? Now, I'm going to give you like a small calculation of how to do that. Now, to look at GDP per capita, there are two problems that you will encounter. The first problem is the problem of currency. Because if you're looking at GDP, the UK will always quote theirs in pound sterling, and then the US will quote theirs in US dollars, and if you're looking at the Eurozone, it will be quoted in euros. So, but then for you as someone that is trying to do an analysis, an exogenous analysis, considering relative GDP of 2, 3, 4 countries, you have to change it into what everybody will call the reserve currency, which is the US dollars. So let's make some assumptions here. The first assumption is first quarter 2020. So Q1 2020 UK GDP, let's say 100 billion. Let's say 100 billion pounds. 100 B. Yeah. 100 billion. Yeah. Yeah. Let's say 100 billion. Now, remember you're looking for the relative GDP. And remember, to get relative GDP, you're trying to get GDP per capita. And you've just seen this data. Q1 2020 UK GDP just came out, first quarter, 100 billion. It's probably going to be about 500 billion, I think. But we are making assumptions here, remember. 100 billion. Now, the first thing to do is to look at the exchange rate. So we are assuming that $1, remember we are trying to convert to the reserve currency, which is the US dollars. So we are assuming that $1 is equals to 0.80 ounce. So which would be ATP. So now we have to convert this into the reserve currency, which is the US dollars. And as you can see here, remember this is just an assumption. It's not an actual market condition, but you can always go on the actual market and recreate what I've just done. So as you can see here, the exchange rate is $1 equals ATP in my assumption. So what then do we do? The GDP, the UK GDP for Q1 is 100 billion. To convert that to the US dollars, we do 100 divided by 0.80. I'll wipe this so that it will be visible. Divided by 0.80. So 100 divided by 0.80 is what?
125.
Okay, 125. Thank you. So it's gonna be 125 billion. So we bring in well now it's going to be in US dollars. So it's going to be USD 125B. So that will be the value, this GDP value for the UK Q1 has just been converted into pounds. That's step one. Remember, what we are trying to do here is to find the GDP per capita. That's the first thing. That's what we are trying to do here. Because once you can find the GDP per capita, then you can comparatively start looking into, okay, this is the UK. So what is Brazil looking like? So what is the US looking like? The Eurozone. And the reason why we're using US dollars is because that's the reserve currency. The market sees US dollars as the reserve currency. And I know a lot of people are going to argue that Chinese currency is going to be the reserve currency in the future, but we are not yet in the future. We are now. Right now, is the US dollars is still seen as the reserve currency. So I'm going to wipe on top the top of the board and then continue with the second step. Second step is very simple. What you need to do with the second step is to then convert, or rather, yeah, then get the number how much, because remember we're looking for GDP per capita, which is for the end user in that economy, how does this value affect them? Like, how does this value relate to them? And that's what we are trying to get now with the GDP per capita. And we've converted this into US dollars. So we're then going to remember this is an assumption. We're going to assume that the population of the UK is whatever, and then divide it with, divide 125 billion by the population of the UK. So what are we going to do here? I hope this thing is dry now. So let's assume the population, pop, is equals to, let's say, 67 million. I think that's the current population of the UK. Do you know? Current population of the UK, this is 7 million right now.
Yeah, I think so.
67 million. So then what do? We do 125B divided by 67 million. This will give you something that should be in. If I want to do this mathematically, I have to put like $sign there and then do your normal sort of BOD math, find X. But I don't like maths, so I'm just going to do it this way. So 125 billion divided by 67 million is how much? I mean, I think the right thing to do is 125 divided by 67. That should be about 1 point something, maybe
1.8.
1.8.
Yes.
Yeah, I think that should be about 1.8. Yeah, about 1.8. So if it's about 1.8, looking at this is billion, has what, nine zeros.
Yeah, so it's about 1.86. So
yeah,
1.9 maybe.
Or 1.87,
No.
1.86,
Yeah.
56, something.
Yeah.
So approximately 1.867. 1.866.
1.866.
Yeah, that's what it's going to be.
Yeah.
So, is if we do without writing zeros to the to the end of the board, because if we're going to do it, have to put 0 in the millions. Without doing that, what this would be is about 1,866, just roughly. You can take your calculator and get the actual figure. So what you can do on your calculator, press 125,000,000 in billion divided by 67,000 in million. You're going to get around this approximately. So it means that for every individual, for that quarter, Q1 2020, for every individual in the UK, this is the end user. Listen, this is just for the quarter. So what then? What does this tell you? With this information, all you need to do is go on an Excel, put down on Excel, write the UK Q1 2020. This is the value. I do this, and I'm telling you now to do that. Create an Excel. It's very simple. You don't even need to, if you don't like Excel, like someone like me, I don't like Excel. I use numbers. So you just need a spreadsheet. So yeah, I use numbers. I go on numbers. I put down this UK Q1 2020, and initially it will seem as if you are just collecting nonsensical data. But then what you then find out within 3 years, 2 years, you start seeing like a trend, and you can start spotting trends just by collecting this data. Very simple, and it's just under exogenous. You get that? So with this, you can have the countries that you're interested in. So we're looking at the Eurozone. We're looking at Japan, possibly, because we're assuming that you are using the information to trade currencies. We're looking at Japan, the UK, the US. So 4 countries. What other? Maybe Australia, maybe Canada, to New Zealand. So you have what, 7 countries, 7 major countries that you would normally trade their currency. So what you can do on that spreadsheet is you now know that this is the GDP per capita for the UK for Q1. GDP per capita. This is the GDP per capita value in US dollars for one person in the UK for Q1 2020. So you can create a spreadsheet that says Q1, Q2, Q3, Q4, and then have the dates, the year, and then have the countries, and then impute these values every time the GDP data comes out.